Most traders look at the market in black and white. They're either bullish or bearish. They either buy or they sell. But professionals, they see the market in shades of balance. And one of the most powerful ways they achieve that balance is through delta-neutral trading strategies. Welcome to Derivatives Trading Mentorship, where we take you behind the curtain of professional trading, showing you the advanced methods, data, and proprietary hedging levels banks and hedge funds actually use. If you want direct access to those numbers, visit www.derivativestrading.com. What does delta neutral mean? At its core, delta neutral trading is about removing directional bias. Every option has a delta, the sensitivity of its price to moves in the underlying. A call option with a delta of 0.5 gains about 50 cents for every $1 increase in the underlying stock. A put with a delta of minus 0.5 loses about 50 cents for that same move. Now imagine you balance those positions, long one, short another, adjusting size until the deltas cancel out. You've just created a delta neutral portfolio. This means your overall position isn't betting on whether the market goes up or down. Instead, your profits come from other factors: volatility, time decay, and the very mechanics of how options interact. Why professionals use delta neutral for hedge funds? Delta neutral strategies are not about gambling, they're about control. If you're long volatility, you build a delta neutral structure that profits from big swings. If you're short volatility, you create a neutral setup that benefits from calm markets. If you're running a structured product, delta neutrality ensures client exposure doesn't blow up your balance sheet. The beauty is in the flexibility. Professionals don't care about predicting direction. They care about creating frameworks where risk is defined, balanced, and constantly hedged. The mechanics of delta neutral. Here's where the professional approach comes in. Identify exposure. Every option position has a delta, add them up across the book, and you'll see your total directional exposure. Balance with offsetting positions. You can neutralize that exposure by adding opposite options or by trading the underlying stock or futures. Monitor gamma. Even when you reach neutrality, gamma ensures that deltas won't stay still. The more gamma you carry, the more often you'll need to adjust. This is why delta neutral is never a one-time adjustment, it's a continuous process. Profit drivers. Once neutral, your profit drivers shift. You're no longer trading direction, instead, you're capturing volatility, mispricing, benefiting from theta, time decay, or exploiting structural flows in the market. This is how professionals consistently extract returns, while retail traders get whipsawed by price action. Examples of delta neutral strategies: long straddle, strangle, buy both a call and put, balance the deltas, and profit from large moves in either direction. Iron condor, sell multiple options to capture premium, hedging deltas to remain neutral while theta works in your favor. Calendar spreads. Take positions in different expiries, remaining neutral while capturing the decay differential. These are just surface-level examples on professional desks. These strategies are executed with size constant re-hedging and proprietary data guiding every adjustment. The professional advantage. What makes the professional approach different? Discipline in hedging. Neutrality isn't optional, it's the foundation. Access to data. They don't guess deltas and gammas, they calculate them with precision. Focus on structure over speculation. The goal isn't to predict, it's to manage. At Derivatives Trading Mentorship, we bring this same framework to you. Using our proprietary delta and gamma hedging levels, you can trade with the same insights hedge funds use to manage billions. You can access this data at www.derivativestrading.com. The takeaway: delta neutral trading isn't about chasing headlines or predicting the next move. It's about building positions where balance is your edge. When you trade like a professional, you stop being at the mercy of market swings, and you start using the mechanics of options to your advantage. That's the professional approach. And that's what we teach here at Derivatives Trading Mentorship. If you found this valuable, subscribe for more deep dives into the strategies banks and hedge funds rely on every single day. And remember, for direct access to our proprietary data and hedging levels, visit www.derivativestrading.com. Thanks for watching Trade with Balance. Think like an institution, and always remember, neutrality is power.